And one of the big parts of this chapter and one of the big parts about bonds is that there's a lot of terminology that's different than what we've been using, even though the mathematics are simply, or not simply, the mathematics are the same as what we've been studying in chapter 5 and 6. Okay, so the mathematics of a bond are the same as the mathematics of any other annuity. Okay, because a bond is an annuity. It promises to make a series of level payments over time with a fixed end date. Okay, a loan doesn't go on forever. It eventually is all repaid. Okay, so the mathematics here is no different. We're going to work these problems. They're going to be exactly the same as the annuity problems that we worked in chapter 6. However, they're going to have a totally new wrapper on it, much like the stock chapter that we just covered. It's going to be the same mathematics with a new wrapper. Okay, so a new place to fit in the world. So we're going to have new terminology. We're going to have new context. New ways to talk about the problem, but otherwise the underlying problems are the same. Now, because the mathematics are the same as those that underlie the math of any other annuity type contract, the problems that from this chapter are going to be solved using the calculator, using the time value of money functions that we've already learned and discussed, using the same formulas, the time value of money formulas that you already know about. And what's going to be different is the terminology that we apply to all the inputs of those formulas. Okay, so the next few slides are going to describe how the terminology is different. And okay, and I'm also going to tell you why the terminology is different. Okay, and it's just based on its historical context. Okay, so the first thing that we'll talk about is the time value of money stuff. Again, we're just going to basically rename all the inputs to the time value of money formula. So in, IY, present value, future value, and payment, all are going to have new terminology around them. And the easiest one to start with is payment, because bonds pay the investor, the lender, using periodic payments based on an interest rate that is set at the issuance of the bond. Issuance is the day the bond is sold, so the day the loan contract is signed. And this is called a coupon. Okay? And the interest rate is called the coupon rate. And those are both for specific reasons that I'll talk about in just a second. Okay, so the interest rate of a bond is called the coupon rate. And the interest payment is called a coupon payment. And this is simply the cost to the issuer, to the company, for raising financing in this method. Right? So in other words, if you borrow money, the cost to you of borrowing money is the interest rate and the interest payments. So if a company, the issuer, borrows money, then the cost to the issuer is the coupon payments on the bonds, and those are decided by the coupon rate. Now, the amount of money that is borrowed is called the face value, or the par value. And again, give me just a second and I'll tell you why this is a different term. This is the amount to be repaid at some point in the future. So this is what our future value is going to be in all these bond valuation problems. Okay? This is simply the amount that is borrowed, and for an individual bond, it is in like 95% of cases, $1,000 per bond. Okay, so companies borrow money in $1,000 chunks, and so each bond is worth 1,000. The total bond issue may be several billion, certainly hundreds of millions of dollars, but that will be collected in $1,000 increments from individual investors. Now, typically, and this isn't completely true anymore, but in the past, it was typically raised by selling 100 bonds at a time, so that the smallest chunk of a bond issue that you could buy, at least at the beginning, was $100,000, so $100,000 bonds. These days, with the rise of more individual investing, it has become easier and easier to buy individual bonds, so that even relatively smaller investors like you or I can participate in this market. It didn't used to be that way, but it's certainly becoming more like that. And so you can participate and be a lender to one of the major corporations in the US. And you can do it through usually whatever sort of stock trading platform that if you participate or ever participate through whatever stock trading platform you end up using. Okay. So the amount that is borrowed is almost always 1,000, which means that the amount that is repaid is almost always 1,000 because you're repaying exactly what you're borrowing. The interest payments will be made separately. So the face value in this class is always going to be 1,000. Okay, so you can just write that down. The face value will always be $1,000. Now maturity is our in. Maturity is the length of time until the bond must be repaid. Okay, and what that means, because this is a loan, because this is a contract, the length of time is stipulated in the beginning when the contract is signed. So we might buy a 5-year bond from Apple, which means we're loaning Apple $1,000 for 5 years. Or we might buy a 10-year bond or a 30-year bond, or even very rarely a 100-year bond. Right? Now, the important thing is that a bond is never an indefinite bond. It doesn't go on forever. Almost never. Very rarely. It's certainly never that way anymore. I've only seen examples of what are called perpetual bonds, and I'll show you an example from olden times. Okay, so there are no modern bonds that go on forever into perpetuity. So they have a limited lifetime, and because it's a contract and because time doesn't stop, that means that there's a sort of distinct difference between what we call the bond's original maturity, which is what's written in the contract. So if I buy a 5-year bond, I loan Apple money for 5 years. That's the original maturity. And the remaining maturity, which is how much time is left, given how much time has passed. So on the day the bond is issued, the original maturity and the remaining maturity are the same, of course, because I lend Apple money today. Well, the remaining maturity is 5 years. The original maturity, the ink is still drying, is 5 years. So those two things are the same. But at any point after the issuance day, the day the bond is sold, the remaining maturity is going to shrink. Right? So a year from now, the original maturity, still 5 years because that's in the contract. But the remaining maturity is now 4 years because that's how much time is left. Okay? The maturity of the bond, when we say maturity, what we mean is the remaining maturity. Okay? Now, sometimes that might be the same as the original maturity, but when we're talking about valuation, the important thing for us is how much time is left, because that is going to determine how many more interest payments we receive, and that's how we're going to value a bond. Right? Remember, the value of anything is the present value of its future cash flows. And for a bond, those cash flows are very explicit. Right? We're not starting this chapter like we started the chapter on equity, trying to talk about what the cash flows of a stock are and how they might come and how they might value and whether they might change and things like that. There is no ambiguity when we're talking about a loan. We know exactly what the cash flows of a bond are going to be. They're going to be the interest payments that we receive, and then they're going to be the face value that we get repaid. Those things don't change. And so what's important for us when we're valuing it is how many of those payments are left. Okay, so when we say maturity, we're talking about remaining maturity, and this is our in the input for the time value of money formula.